All right, everybody, welcome back. We're going to do a little bit different things today. 22 rules of trading. Now, these are things that I have collected from multiple sources. I'm not saying that I wrote these. I'm saying that I have gathered these. Okay, so I don't want to hear anybody complaining, hey, I heard that somewhere else. Yeah, you probably did, because I did too. 22 rules of trading. Never under any circumstances add to a losing position. Okay, if you think the trade is a loser, we don't add to it. Now, we're not talking about looking at your P&L and being down in a trade. I'm down in a trade that's a winner. That's a completely different thing. If it's a losing trade, trade like a mercenary. We must fight on the winning side, and we must be willing to change sides. Capital comes in two varieties: your mental capital and the capital in your pocket. Of the two accounts, the mental one is the more important and the most expensive. Holding on to losing positions costs measurable sums of actual capital, but it mentally runs your capital dry. The objective is not to buy low, sell high, but buy high, sell higher. We can never know what price is low, nor can we ever know what price is high. Always remember that sugar once fell from $1.25 a pound to 2 cents a pound, and it seemed cheap many times along the way. In bull markets, we can only be long or neutral. And in bear markets, we can only be short or neutral. Now, that may seem very self-evident, but it is not. And it is a lesson learned too late by far too many. Markets can remain illogical longer than you and I can remain solvent. Illogic often reigns, and markets are enormously inefficient, despite what the academics believe. Just take a look at GameStop. Sell markets that show the greatest weakness and buy those that show the greatest strength. Metaphorically, when bearish, throw your rocks into the wettest paper sack. In bull markets, we need to ride upon the strongest winds. They'll carry us higher. Try to trade the first day of a gap, for gaps usually indicate violent new action. We have come to respect gaps in our nearly 30 years of watching markets. When they happen, especially in stocks, they are usually very important. Trading runs in cycles, some good, most bad. Trade large and aggressively when trading well. Trade small and modestly when trading poorly. That would be like right now in these conditions in February 2022. In good times, even errors are profitable, but in bad times, even the most well-researched trades go awry. That's the nature of trading. You just have to accept it. To trade successfully, think like a fundamentalist, trade like a technician. It is imperative that we understand the fundamentals driving a trade, but also that we understand the market's technicals. When we do, we should, we can, and we will trade. Respect outside reversals after extended bull or bear runs. Reversal days on the charts signal the final exhaustion of the bullish or bearish forces that drove the market previously. Respect them, and respect even more weekly and monthly reversals. Keep your technical systems simple. Complicated systems breed confusion. Simplicity breeds elegance. Respect and embrace the very normal 50, to 62% retracements that take prices back to major trends. If a trade is missed, wait patiently for the market to retrace. Far more often than not, retracements do happen, just as we are about to give up and think that they won't. An understanding of mass psychology is often more important than understanding of economics. Markets are driven by human beings making human errors and also making superhuman insights. Establish initial positions on strength in bull markets and on weakness in bear markets. The first edition should also be added on strength as the market shows the trend to be working. After that, additions are to be added on retracements. Bear markets are more violent than bull markets, and also so are their retracements. Be patient with winning trades. Be completely impatient with losing trades. Remember, it is quite possible to make large sums trading and investing if we are right only 30% of the time, as long as our losses are small and our profits are large. The market is the sum total of the wisdom and the ignorance of all those who deal in it, and we don't want to argue with the market's wisdom. Do more of what works and less of what is not working. If a market is strong, buy more. If a market is weak, sell more. New highs are to be bought. New lows are to be sold. The hard trade is the right trade. If it's easy to sell, don't do it. If it's easy to buy, don't do it. Do the trade that is hard and do that which the crowd finds objectionable. There is never one cockroach. All rules are meant to be broken. The trick is knowing when and how indifferently this rule may be invoked. That's it, guys. 22 rules of trading. Really ponder upon these. There's a lot of insight. There's a lot of wisdom there in so many different ways. It's the foundation of everything. Thanks for your time. I'll see y'all at the next one.